Good afternoon, everybody. Uneducated economist here. Got a couple of articles I want to share with you. Links are down in the description as always. You can always find the links down in the description. One of them is talking about the illiquidity that is plaguing the Treasury market. Not a surprise. This is something that I had said that we need to focus on probably about 2 or 3 years ago. I said, keep an eye on the bond market. Bond market is going to be signaling everything. Once the bond market starts to show issues, especially when it comes to corporate debt or the sovereign debt, we are going to find like some serious bad times coming into the future. You know, a lot of people looked at the great financial crisis and talked about the subprime mortgage housing market that took down the whole financial system. I mean, it took down the entire global financial system, almost crashed it if it wasn't for the Federal Reserve stepping up with their quantitative easings. If you could imagine what a sovereign debt crisis would look like, I mean, when nations around the world are failing, that is going to be a very scary scenario, and we could be running into that right now. The U.S. Treasury market is the most liquid market in the entire world. If you are holding U.S. Treasuries, you might as well be holding dollars. Right? I mean, it's almost the same thing. In fact, it's a little nicer to hold Treasuries, especially the short-term notes, because there practically are cash, and if they do happen to drop as far as price goes, most of the time you can just let them go ahead and mature and get your cash back out of them. So treasuries are a very, very sound liquid investment and item to hold, even if you're doing transactions, because a lot of people as far as like sovereign nations and corporations around the world will accept treasuries as if they are dollars. However, if you come into a situation in which that those treasuries are starting to lose value and the yields are beginning to rise, it starts turning into a hot potato where people are like, I'm not touching this thing, no way. The yields keep rising, the prices keep dropping. As soon as I buy this thing, the price of it is going to fall, and I'll have to hold on to it for maturity in order to get my money back out of it. See, this is where the idea of investment and speculation really confuses a lot of people, because I've heard many times, do you invest in gold? Do you invest in Bitcoin? You cannot possibly invest in these things. They are not investable items. Now, it is an investment if you are getting a return. So there is places that you can say put your Bitcoin, a third party that you can lend it to, who will pay you an interest on it. That is an investment. You are giving that money, that Bitcoin, over to another third party who is then going to promise to give you some sort of return on it. Whether you get the return or not, that's the risk that you take. And hopefully the risk that you take is worth the reward that you get from the interest that you earn from the Bitcoin that you have given to that third party. That is an investment. Speculation is, I bought this Bitcoin and in 3 years I'm going to sell it for a profit. I'm going to sell it to the greater fool. That is a complete speculation. So there's a difference between investing and speculation. And this, for years and years, there was always this combating kind of scenario between the two of bondholders and gold holders. And the bondholders said that gold holders were buying a dumb asset, that they were just going to buy something that was going to sit on the shelf and wasn't going to collect an interest. At least if you held a bond, you would get an interest rate from it. So bond investors were just that. They were investing in the bond so they could get some sort of return off of it. Gold investors weren't investing. They were speculating on anticipation of selling it to the greater fool. Here's the problem. Bonds and the prices that they paid, like the yield that an investor would earn, right? So the amount the investment would pay to the investor for buying these bonds had dropped so much that it didn't really pay. Like, it was no longer an investment. So why would anybody buy these bonds? Because the Federal Reserve kept pushing interest rates lower. And if you push interest rates lower, it causes the bond prices to go up. Yields work inversely to price. So as the yields began to drop and the prices began to fall, the people who were holding bonds, who didn't really care about getting that interest rate, that yield, because it was so low, was able to sell that bond for a profit. All of a sudden, it became the idea that you were going to sell it to the greater fool. That's what happens when interest rates dropped as low as they have. So now here you are out there in this economy where you have hedge funds, insurance companies, all kinds of like entities out there who want to hold an investment that pays a return. Typically, that would have been the U.S. Treasury. It would have been the go-to. But it doesn't pay enough yield. So you think about it, back in the early 80s, you could have bought 10-year treasuries if you had $1 million invested. I've used this scenario before. Say you inherited $1 million back in the early 80s, you could have invested that with the government. You could have loaned the government the money. Say, here, I'm going to buy a bunch of 10-year bonds off of you. The interest that those 10-year bonds would have paid the investor would have been something like around $100,000 or more a year for $1 million investment lent to the government. That's a pretty good return for a guaranteed, no doubt, going to pay, zero chance of default. Alan Greenspan said that a long time ago. The U.S. government has zero chance of default. None. They can always pay any debt, any bill it has. It has a printing press to do it. But what he said is that they cannot guarantee the purchasing power of that money. So there is zero doubt that the U.S. Treasury will make its payment. Very little doubt. However, back in the day when you could invest with the U.S. Treasury and get a $100,000 return for your $1 million investment, $1 million today invested with U.S. Treasuries would pay you like $15,000, $20,000 a year for $1 million invested with them. It would hardly even earn you a living. Back in the early 80s, you could earn a great living just by lending the money to the government. You could buy houses and cars and go on vacation and spend that money all over the place. But when the interest rates drop as low as they have, they just don't pay like they once did. And then money velocity begins to slow down because of it. This is one of the things that Dr. Lacey Hunt talks about. So now here are these investors who are typically wanting to get into the safe return or the safe haven returns that come from the U.S. Treasuries. The amount that they return is just too low. And unless you're speculating, then they really don't seem worthy of an actual investment. So they start moving into riskier investments. They start getting into the corporate bonds. They start getting into emerging markets. They start getting into the places that will pay a higher yield to it because they're looking for some sort of return. They're trying to invest this money. But with the yield so low, it's very difficult. So this is where the situation that we're coming into now is that once the interest rates begin to rise, these corporations, these who really enjoyed the low interest rates, the low interest rate environment, were gorging on this debt. I mean, here are all these investors, these pension funds, these insurance companies, all these people were looking to find some sort of return, couldn't find it in the U.S. Treasury, started reaching out there on the risk scale and started getting into the corporate debt, and they started feeding these zombies. So all this money is going into these corporations who are just gorging on this debt. Oops, forgot to turn my radio off. Sorry about that. So anyway, these corporations are gorging on this debt. Well, now here the situation changes and the interest rates begin to rise, and the investors are now looking at that risk going, I don't think so. I mean, you guys have been gorging on this debt, you're way over indebted, and the idea that we're going to give you any more money is just not really in it. Take a look at Evergrande. Evergrande is a Chinese corporation that had been borrowing money in dollars. Why? Because they get the best interest rate. Now, they borrow more money in their local domestic currency, but it doesn't matter because it's those dollar bonds that really set the precedence. So if those dollar bonds are failing, the rest of the system begins to fail too. And if Evergrande, the number one builder, the property developer in the entire world, is having issues, it starts dragging down the rest of the corporations too that are within the field or even related to that company. And now this is what we're going to see moving over here into the United States. These interest rates are going to rise. You see it happening with the U.S. Treasuries right now. Everybody's looking at the 2-year, 10-year. Go look at the 5-year, 30-year. I'll leave a link down in the description to that chart. Incredible. It's about ready to invert. And that was Alan Greenspan's indicator. And he says when you see that spread widening, that's corporate management's willingness to invest. Well, that spread is shrinking and shrinking fast. More so than it did back in 2018 prior to the COVID recession, which I saw somebody mention this. Sorry, I'm kind of going off here a little bit. But somebody mentioned this in the comments section. They said, I thought COVID would have covered up the recession. It was COVID did cover up the recession. If it wasn't for COVID, the Federal Reserve and the Treasury would never have had the what do they call that? Extenuating circumstances. right? Unusual and exigent, that's what it was. Unusual and exigent circumstances that allowed them to create the special purpose vehicles that they used to backstop pretty much every corner of the financial markets during the whole COVID lockdowns and everything else that took place. All that stimulus, that was COVID recession cover up. A lot of people don't realize we went through the deepest, fastest recession in history, and it was all papered over. It was self-induced with the supply chain breakdown, severing of that supply chain, telling everybody to go home, do not go out and do anything. Only the essential companies can stay in operation, and here's a bunch of money. Go and wipe out that inventory. I mean, to me, it was as clear as day. It was like, I know a lot of people would probably argue with me on it, but if they did not have the COVID pandemic crisis taking place, we would have been in some serious economic hell, because they would not have had the excuse to have the unusual and exigent circumstances to allow for those special purpose vehicles to be built. Uneducated economist. You guys let me know.